It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. So glad you can join us today. It is the Jill on Money show. I know you're probably out, hustling around, doing a little shopping, getting ready for the end of year, all that fun stuff. Hanukkah's over, Christmas ahead of us, a lot of stuff going on. We are broadcasting live from the Capital One Bank Studios here on the far west side of Manhattan. And we are delighted that you can join us, and we are always grateful when people take the time to email us, ask us questions, anything going on in their financial lives. That email address, just so you remember, askjill@jillonmoney.com, askjill@jillonmoney.com. And also, we say this throughout the show, but if you ever have a question and you can't remember anything, you don't like to use email, go to jillonmoney.com. And you can just click on the Contact Us button. But you can also do things like read articles that we have written and posted, listen to past programs, or maybe you want to subscribe to our podcast, or maybe you want to watch my TV segments and give me an analysis of my outfit, which thank you all very much for doing. I don't know if you remember this, but I have a Jewish mother, so you don't need to actually tell me about that. That's covered, but I appreciate all the comments that I do receive. You can also sign up for our free weekly newsletter. We're chugging along there. Mark, how many do we have right now? He says it's rising slowly, but he won't give me the number. 20. Okay. We want that to be higher. Well, we had this newsletter subscription, and then it was going great. And then all of a sudden, we had to send out a privacy notice, and a whole bunch of people didn't sign the privacy notice. I don't know what percentage, but I know it's a pain in the neck anyway. We do not sell anything about you, your information, your data, because I wouldn't even know where to start to do that. Luckily, I'm a dope, so now I don't even know how to monetize all of you guys. I just like to send you free stuff, and I encourage you to pre-order my book, The Dumb Things Smart People Do With Their Money. You're going to hear a lot more about this. The book drops February 5th. I'm going to be all over the place. But you might notice that your story could be told in that book, or maybe not. We'll see. But we also have a lot of our previous guests who have been quoted in the book, and you'll recognize lots of names there. So it's great fun. And thank you all in advance for buying the book. It's the least you can do for all this hard work that Mark and I are doing, toiling away. All right. Next, let us get to a phone call. That is how we like to start the program. Mike is on the line. Mike, welcome to Jill on Money. How are you?
Thank you. Good morning. It's a wonderful day here in Minnesota.
Tell me about what's going on in Minnesota today.
It's a little overcast, but it's a little cold. We had a little snow last weekend, and we celebrated welcoming Christmas into our community last weekend, and with a twinkle parade, and we're moving on, getting ready for Christmas.
All right. And Mike, of course, Mark and I are big hockey fans. Are you a Minnesota Wild fan?
I'm a Wild fan, and I'm a local hockey fan, too, with all our high school teams and our college teams.
You know, the thing is, when I go on with Dave Lee on WCCO, he knows every single Minnesota player from like the junior league, high school players, and where that kid ended up in the NHL. It's amazing. Like, you guys will root for anyone from Minnesota almost regardless of what team he's on, right?
Oh, you bet. I love hockey. I actually grew up in Iowa, but now I wish we had had hockey growing up. It's such a fabulous sport.
It really is. Anyway, so I never played, and I am a great fan, and I thank you so much for calling us. So tell me about what I can do to help you out today.
Well, I retired 3 years ago. I do have a pension, and we are both collecting Social Security. And all those years of working, I put money away in deferred compensation. And now that we retired, I was listening to a radio show, another radio show one day, and they were talking about taking money out of your deferred compensation and putting in the Roth IRAs.
Mm-hmm.
And I'm almost 65 years old.
Mm-hmm.
I'm debating whether to take some of that money, that retirement money, and put it into Roth IRAs.
Fantastic. Okay, let's do a little bit of housekeeping here. So how much money do you have right now in IRA accounts?
Almost 1.2 million.
Okay, that's fabulous. And how about money that is in non-retirement accounts?
Probably 40, 50,000.
So almost all of your money. You don't have any investments outside of retirement accounts?
Not right now.
Interesting. Okay. And in the money that you're earning, tell me how much money together are you earning?
Right now, with our retirements and pensions, close to $90,000.
And is that sufficient for you to live on? Is that more than you need? Do you need to be pulling money out of these accounts or not?
No, that's sufficient.
Okay. And is it?
Our home is paid for. Our home is paid for.
Nice. Okay. And how about kids? What do you got?
We have 2 grown children.
Oh, fabulous. And are they doing well financially?
I wish I'd have done that well financially.
Good for you. Okay. So the idea of transferring a pre-tax retirement contribution into a Roth is kind of fabulous. However, I have a huge caveat for you. And the caveat is that you need to have the money to pay the tax due from outside of that account. And I don't feel comfortable advising you to do this if you're going to suck up that $40,000 to $50,000 of non-retirement money. So the way that I would see this working for you is if you said to me, oh, well, my great auntie just left me $500,000, and now my non-qualified asset, instead of being 40 or 50 grand, is $500,000, then you'd have the money to pay the tax due. But with the amount of money you have in your IRAs versus the amount of money you have in non-retirement assets, I know I would prefer if you could actually do the conversion, but unfortunately, because of the way that your money has been invested and where you kind of chose to do pre-tax versus post-tax, that is the one thing that I would say I'm not so psyched about. So is there any chance that you are going to essentially be able to beef up that non-qualified asset chunk or not?
I don't think so at this time.
And I think you just do nothing. I think you just, when you turn 70 and a half, you'll take your required minimum distributions, you'll pay the tax that's due, and you add that to your non-qualified accounts. But unless you have money outside of retirement to pay the taxes, then the conversion from a pre-tax retirement plan into a Roth just doesn't work. Thanks so much for calling, Mike. Great question, and go wild. Good luck to you. You're listening to Jill on Money. If you've got a financial question, we want to hear from you. The email address is askjill@jillonmoney.com. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. So glad that you have joined us. It's fantastic. Every single week, we get great emails from all of you. I want to thank you for that. I also want to say that without those emails, I don't think I would have been able to actually write my whole book. Yes, I have a lot of client experiences that were really interesting, but the calls that I've gotten since we have gone on the air are like inspiring. So if you want to see what I'm talking about, hop onto our website, jillonmoney.com, click on the book, and you can pre-order The Dumb Things Smart People Do with Their Money. That's JillOnMoney.com. Also, while you're there, you, of course, can go on and look at all the stuff that we've done recently, read the articles we've written, listen to past shows, watch TV segments and videos, and sign up for a free weekly newsletter. All right, so let's go and take a call. This is Monica from Brooklyn. Hi, Monica. How can I help you out?
So I'm 36 years old, currently contributing maximum for my 401k. I have a good amount in savings. Also, last year I started investing directly in specific stocks. Mm-hmm. So I'm trying to figure out what are my best options at this point outside of the retirement account.
Okay.
Is for someone in my position to get more return of the money I have saved. So either to be able to invest in another real estate or to possibly retire early.
Look at you. You're 36 and you're talking about early retirement?
Yeah.
Who says that Gen X is behind in retirement? So, Monica, how much do you earn?
I earn around $120.
Okay.
With bonus, with everything.
Okay, fantastic. And so you're putting $18,500 this year into your 401k, right?
Yes.
Okay,
yes.
great.
This is the first year I'm going to be full on.
Great.
So currently I have, I can take you through my finances.
Mm-hmm.
So I have around 150 in my 401k.
Uh-huh.
I have around another 10,000 in additional IRA. I have some company stocks that I buy at a discount, so that's around 7,000. And then I have, in my savings, I have 150,000.
What? Wait a minute. Just plain old savings account?
Yeah.
Oh, my God. You're getting like 5,000 gold stars right now. And how much money in the little stock account?
60,000. 63,000 in the stocks that I'm picking individually.
Oh, my God. You're unbelievable. You're fantastic. Do you own or rent?
I own two-family house in Brooklyn that I purchased in 2008 when the prices went down. Yeah, so I'm currently renting it out completely, and I moved back with my parents for a little bit to just like kind of, you know.
Wait a minute. I love this. So you bought a house in 2008 at the bottom.
Yes.
How much did you pay for it?
$690.
And what do you think it's worth now?
1.2.
Oh, my gosh. It's fantastic. And what kind of mortgage do you have on it?
I have around $3,400. That includes insurance and taxes.
The
monthly.
outstanding balance, do you know how much that is?
$460.
Okay.
$450.
Okay. So the rent that comes in from now it's two families. So what is the rent that is being generated from this house?
The net I get from that is around $2,300.
The net after you pay for all of your expenses. So
Yeah.
that's why you're saving so much money.
Yeah.
You're absolutely amazing. This is a fantastic situation. Do you want to keep the two-family house as a rental and buy something else? Is that sort of what's cooking around in your brain?
Yes, but the real estate nowadays is just impossible. I mean, I've been looking, but it's just the numbers never work out.
Yeah.
The way. So I would love to have this house generate income and then get something just for myself. But I just don't see that working out. And with the prices of the houses and how much I would have to pay mortgage, just doesn't make sense.
Yeah, I mean, especially since you already own something, and you would be happy living in one side of the house.
Yeah.
Okay.
If the worst case scenario, I'll probably move into one of the apartments, but that would mean that my income would probably at least went down by half, if not 2/3.
All right, but big deal. I mean, you got a chunk of money, so you're in great shape. So the money that you have in savings, that $150,000, why is that sitting in cash at this point? Just because you don't know what to do with it?
Yes, basically. I started investing, like I said, last year, and I just started picking some of the stocks that I started reading about and following, and and they've been doing pretty well.
Yeah.
But I don't want to. I'm pretty tolerant. I don't really mind that much. But the issue is that I always know that I have to have certain amount of savings, probably around 50 or 60,000 would be sufficient for me. So it's just finding the best. If it's not real estate, which doesn't seem like it's going to be in the next couple of years, looking at the market, what else can I do so it's, so I get that benefit?
I think the next level for you is that now that you're maxing out your 401k, and I'm going to leave the stock investing aside for a second, I think that maybe it would be interesting for you to use this savings account to become what I would call a supplemental retirement account. And what you would do is you would kind of challenge yourself and say, hey, what would happen if, I left my stock account alone, I used this supplemental general investment / retirement account to see what it's like to be an index investor. Maybe what you would do is you would say, I don't need to be as risky right now with that money. Since I've got a bunch of stock money in stocks already, maybe I would just pick 4 or 5 different index funds, create a diversified portfolio, a nice asset allocation plan, and maybe have some stocks, U.S., international, some bonds, maybe have a little commodities exposure and do that. But I think that the reality is that you do the hard part of what I try to encourage people to do, which is save. The easy part is how to invest it.
With index funds, you can take the money out at any point.
Anytime. Anytime. There's nothing that you're not committing to anything. What you are essentially saying is, I'm going to invest. You can find an index fund anywhere. You can use a robo-advisor, but you are trying to drive down the cost of investing. So you're trying to say, I want to keep my investing costs to under, let's say 0.25% a year, and that's it. And then you can pick your own allocation. You can say how risky you want to be, how much in stock index funds, how much is in bond index funds. You can really start to check that out. In your case specifically, because you have so much income, right? Because you have this money that's coming in from the rental. I know it's going to be reduced, but you also have good income. You may want to be just aware that index funds, because it's outside of a retirement account, that it's a more efficient way for you to invest because they're not turning over all the time. It's a fixed basket of assets that you're buying. That's what I would say, that, you're ready to jump into the next rung of retirement savings, which is a supplemental account. The stock investing, look, I'm not an individual stock picker. I'm really not. I'm a believer in index funds. If you want to keep fooling around with the stock stuff and you like that, that's cool. I wouldn't put a lot more money in there. I think that's just fine the way it is. If you've got some good gains or if you've got some losses, be sure to manage that efficiently just in terms of your tax liability. I think that you're in fantastic shape. I really do. I don't think you need to do a lot more. I think you just have to, stick with your plan.
Okay, perfect. All right, so that's what I was wondering about, if I should go also into the try to get some sort of advisor, or an index funds were also on my list of possibilities. So that's really great.
If you need financial advice and you want to go talk to a certified financial planner because something's going on in your life, or you're contemplating the sale, or you're getting married, or some life event is occurring, then sure, I think that it's worth going. But for just plain old asset allocation, to put a plan together like that, I think that you're in very good shape. It's a commodity, essentially. You can get that really cheap, either through an index fund or through a robo-advisor. Either way. We'll get back to more of your fantastic calls. Got to pay some bills, though. When we come back, lots of excitement here. Maybe you can go surf around and do some shopping for the holidays. Just a couple weeks to go. Good luck. We'll be right back.
If you've missed any part of the show or want to check out a past show, go to JillOnMoney.com for more great personal finance content.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Here at the Capital One Bank Studios. Just love to hear from you. All you have to do is send us a note. Ask Jill at JillOnMoney.com. Hey, by the way, if you've missed any of our recent shows and you're like, you tuned in a little bit late. Oh, what was that? Just go to the website, JillOnMoney.com. And while you're there, you can just click on the listen button and you might see stuff that's out there. You can listen to this show, our sister broadcast, the Better Off podcast. You can read various things that I have written. You can watch television segments. All of that. Oh, and you can click on the link to book, and then you can pre-order my book, which will be available February 5th, 2019. Pre-order it now while you can. Come on. I don't know. I think I've got to try to get a bunch of pre-orders, so that's why I'm asking you. So please do it. Click it on. Click it. Lots of different places where you can buy it. The name of the book is The Dumb Things Smart People Do with Their Money. All right, let's get through some emails right now. This is from Joel, who says, I'm a new listener. This is so great. He says, I just tuned in the past couple of weeks. I think I've listened to about half of your total podcasts already. How nice is that? Anyway, I may be guilty of putting the cart before the horse, but you can't believe how difficult it was to have someone from a financial institution that I bank with, my primary bank, insurance, mortgage, whatever, to follow up with me in opening an account, a Roth IRA account. So here's my motivation to open up a Roth IRA. My daughter's 1.5. My wife and I have a goal to open up an account when our daughter turned 1. So 6 months or so, I've dealt with researching and wanted to find somebody. And anyway, I went online. One of my financial institutions helped me go through the steps of opening it there. I entered the info and I picked an investment, a target retirement fund. I deposited money. That's it so far. I just want to deposit money into this thing, have the investments managed for me. I'm no expert in what stocks to pick. I want to make sure the investment is allocated well. I'm a moderate risk taker, but it's for my daughter. She's the primary beneficiary. In the long run, I might want to lean more towards the conservative side. Although, think about this. If it's really for your daughter, maybe you don't want to be so conservative. Maybe you want to be a little bit more aggressive. I don't know. Okay, so I want investing for growth by the time she's in her college years, maybe a possible college funding source. We will open a 529, but I want to be early for retirement. I won't be accounting for this in my retirement. It's just the hopes that there's some in there after she completes the degree. Anyway, so here's what I'm asking guidance for. Do I have it set up correctly that I'm putting money in and it's just set to grow? How should the investments be allocated? Thank you so much. I enjoy all parts of your podcast, even if I believe Mark is just an imaginary friend. Mark, are you going to prove this man wrong ever? He's so real, he says. But he could be an imaginary. I never had an imaginary friend when I was a kid, actually. Mark, you'd be a good imaginary friend. Okay, so yeah, you can set this up. You can have it in a target retirement fund. But, you're probably better off instead of a target retirement fund just to put the money in an index fund. I mean, this fund specifically, I just pulled it up, and I just wanted to look at the expense ratio. This expenses of the fund you've asked me about, which is a target retirement fund through USAA, has an expense ratio of 0.8%. You know what I would do? I would just literally buy a stock index fund and a bond index fund. And I think that you don't need to be so conservative. I think you're probably better off just making it be a growth portfolio, like 70% stocks and 30% bonds, and not worry about it. And you're fine. Keep going. If I've not answered your question completely, let me know. Okay, Kim lives in New York City. She works for a startup that doesn't offer a 401k. I had an old 401k from a previous employer, rolled it into an IRA, and now contribute $5,500 a year. However, I make too much for the $5,500 to reduce my net income for tax purposes. I have that IRA, an investment account, and another Roth IRA. I also have 6 months worth of cash. What else can I do to invest and supplement my efforts to save for retirement? Because $5,500 a year is not enough with the IRA. You can use how about just a plain old investment account? I mean, in some respects, one could argue that because tax rates are so low right now, you might as well just pay the tax due and invest and have it be a supplemental retirement account. I think that's probably where I would go with this. And I think that sometimes the most obvious choice, opening up an account, buying some index funds, going to sleep at night, is the best choice. So tell me what you think about that, Kim. And let's not complicate matters. Here is a note from Steve, who's got a two-part question about Social Security and Roth IRAs. He says, everything I read basically says wait till 70 to claim Social Security, especially if you're married and the higher earning spouse. I understand the logic of the 8% increase for every year you wait. It seems major changes are coming to Social Security. Given the current state of Social Security Trust Fund, do you think those 8% increases will be maintained? The answer is yes. I do. I absolutely do. In a similar vein, I've been reading a lot of literature with respect to pros and cons of traditional versus Roth 401k. Majority of advice, young folks should go with a Roth. But some people feel that the ever-increasing national debt with that Roth earnings will someday be taxed. My daughter just started a new job trying to decide between traditional and Roth, hence the concern and the question. Hey, here's the deal. We cannot predict the future, as you even say. But I would believe that Social Security is not going to change that 8% bump for every year you wait anytime soon. But I will say about your daughter, I also think that anyone who uses a Roth account of any type will end up being grandfathered in, even if they do change the law. And so you might as well use it while it's there. It's an amazing, amazing type of account. So, yes, use your Roth. All right. By the way, you may want to go back and listen to our interview with Ed Slott, who is unbelievable because he is just like the biggest fan of the Roth out there. Let's put a link to the Ed Slott podcast or radio show in our show notes. Okay, you're listening to Jill on Money. Go to JillOnMoney.com if you want to listen to past shows and send us a note. Ask Jill at JillOnMoney.com. We'll be right back.
(401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. I know it's December. Quit your whining that you don't want to deal with your financial life. Too bad. You're going to do it. I'm totally kidding you. Although whenever I do talk about year-end financial planning with people, producers or friends, I do sense a tiny eye roll. Like, oh, thanks, Jill. Great. This sounds like really, really fun. Or we could talk about what I'm getting someone for Christmas. Or Hanukkah. All right. This person has a very recognizable name, so I'm just going to call him TR. Okay. And the subject is a variable annuity. Hi, Jill. My financial advisor is proposing that I invest in a River Source Rava 5 Advantage variable annuity. It's 10 years with an optional living benefit for an additional 1.35% fee. Has a death benefit. I've had an annuity which had a 7-year lock-in, and it comes full term this month. It has gone from, you ready for this, $350,000 to $480,000. That's not that good. Let's do that math for a second. 7 years. The market soared in the past 7 years. It's okay. It's not great. Okay. He wants to roll this money into the new annuity plus the IRA money I have with him. Oh, my God. Mark, no wonder you told me this was a doozy. That would be a total of $660,000. It would be joint with my spouse. I'm 55. Spouse is 60. It says it will have a 6% annual credit, the opportunity to lock in gains if the funds do better than expected. After 10 years, we'd get $50,000 in minimum lifetime income if we die, blah, 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 blah. What do you think? Is this a good deal? Should I invest in the brokerage account IRA that I have with a financial advisor? Thanks so much for your help and advice. Mark, my hair has gone fire right now. Okay. Let's just kind of go back in time. The 7 years you've made money. There is absolutely no reason why you should roll any of this money into yet another annuity and lock it up. And in fact, I don't think that this is somebody that you actually want to have manage your money at all, simply because the advisor is not an advisor. The advisor is a salesperson. And I cannot believe that somebody would tell you to lock up $660,000, your entire liquidity, into an illiquid product right at the cusp of you actually potentially needing the money. Oh, my God. Mark, I need to calm down. Give me the Klonopin stat. I need an anti-anxiety drug for this. No, don't do this. And in fact, Mark, make sure we send this link to this and send the NAPFA website, NAPFA.org. You need a fee-only advisor who's not going to put you into this crap. Here we go. Here's another one. Single premium and immediate annuity. Here's from Sue. We have almost all of our 401k in a managed account with Fidelity. Our Fidelity financial planner is suggesting a single premium immediate annuity with half of the money. She said she felt we would be fine leaving all of it in the managed account, but wanted to offer this as an alternative. A sure bucket of money each month, not having to watch the stock market so closely. One bad thing is that it is irrevocable. If all of it is not used when we die, it goes to our children. If I live past 81, I break even. Blah, blah. If the company is this, if we did it right, we'd like to start right away. Thanks so much for your help. Sue, really? First of all, I presume you don't mean your 401k. I presume you mean the money that rolled over from your 401k that was previously at Fidelity, which they very kindly said would take it into an IRA rollover account. There is no way this is a financial planner. There is no way that this is a... First of all, why don't you ask your lovely financial planner this question? Oh, if I were to do this, how much money would you make? How much would it cost me? Why would I take half of my liquidity and throw it into an annuity? And no, just say no. I want everybody to actually practice this with me. When someone says annuity, your first reaction should be, no, let's wait on that. It may not be the worst idea in the world. I'm going to tell you that there are some fraction of cases where an annuity can work. But I would say it's the minority, not the majority. So, Sue, please, no. No, just say no. Wait, what? Just say no. Okay. And be sure to ask these people who are suggesting these annuities the key question, which is, how much is this going to cost me? What is the commission you receive? Why would I take all the money I have that is currently nice and free and easy and liquid and turn it into an illiquid asset? Why would I do that? Sue, please. Please, please. I honestly think that you're trying to drive me crazy today, Mark. Many more annuity questions. That just tells me that the salesmen are out and shaking the trees. We got to protect you. Just say no. Annuities are not all bad, but they require a lot of analysis, and preferably from somebody who has your best interest. Puts your best interest first before his or the company's or anyone else's. All right. Calm down, Jill. You're listening to Jill on Money. During the break, go check out the website, JillOnMoney.com. You can sign up for our free weekly newsletter, and also you can pre-order the book, The Dumb Things Smart People Do With Their Money, like buy annuities. We'll be right back. You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. You can just send us an email. Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. George says that there is a guy on the radio in the Bay Area who's got these serious infomercials out, and he's pushing Index Universal Life Insurance from Allianz. Allianz, the big German insurance company, also, I believe, the insurance company to the Third Reich, in case anyone was wondering. Go to their website. They have a whole special section on 1939 to 1945. Anyway, he's got an acronym for his program, Liquid Assets Safety Earning Returns, Laser Fund. He's selling whole life insurance And its return is tied to several indexes. He says he's been getting 7, 8, 10, sometimes 16, 20% return with no market risk. Stop right there. That is baloney. I mean, it is absolute, unadulterated balderdash. You don't get 7, 8, 10, 16, 20% return with no risk. Okay? And the claim that life insurance is cheaper in the long run compared to financial advisors is really baloney, because most of this insurance has costs of maybe 2 to 3%. So the question that you're asking, is this too good to be true? Yes. Can it work the way he claims? I guess you can, have a year or two where where it's good. What do I advise? I advise when someone is hawking something as an infomercial, that you ignore it. That goes for your late night cable TV gold hucksters selling those kinds of things. That goes for the people selling reverse mortgages late at night. And I am incensed that people are doing this and falling for this. And that's just, frankly, I think it might be just a complete lie. So please, please, please try to turn it off, tune it out, George. Stick to a diversified portfolio of index funds, and you will be just fine. Okay, that's it. That's hour one. During the break, hop onto the website. You can read, listen, watch, sign up for our free weekly newsletter, and pre-order the book. You can do all of that. Just go to JillOnMoney.com. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of Jill on Money. We are broadcasting live from the Capital One Bank Studios. All right, here we go. It's really getting down to it. We promised it. We've been waiting for the perfect time. And now is that time. It's year-end financial planning, money moves you've got to make over the next couple of weeks. And some of this is really contemplating what you think is going to happen this year versus next year. We've got Michael Goodman, the founder and president of Wealthstream Advisors, and his associate, Brenna McLoughlin, who is a CFP, a little bit younger, maybe can speak to some of you young folks out there. They are going to take us through the myriad of options for your year-end planning. And we start this segment with trying to figure out why it is so hard to help all of you do what you know you should be doing. Here is our interview with Michael Goodman and Brenna McLoughlin. Okay, so we're talking about the year-end planning, and why is it so hard for us to get people to eat their vegetables? Do their year-end financial planning or tax planning? You're essentially saying to somebody, we want to help you save money. Why do you think people have that barrier to doing this?
I think people are still a little bit intimidated by finance, and that's something that we really try to work on, is making people feel educated and empowered so that these tasks don't seem so hard to tackle and they seem like things that they can take care of and really improve their financial lives.
But Michael, why? What do you think? You've got very sophisticated people, smart people, right? You got a great clientele. Why is it that people just can't get their minds focused around this? Do they basically say, you just do it? They don't want to be bothered? What's your experience?
Well, the clients that we typically work for, no doubt, are traditionally good delegators of that, not only because perhaps they aren't interested in it, but also because they appreciate working with an expert. As we've all moved further in our careers, everybody's become very specialist-oriented. Mm-hmm. So knowing that you can go to this for this is a wonderful thing.
Brenna, this is an interesting year because this is our first year of tax reform or tax cuts. Mm-hmm. Let's say people don't have advisors. They're doing this themselves. Best place to start, what do they need to do first?
I think it would be a great place to start by looking at 2017's tax return.
And what am I going to look for there?
Whether your income has changed significantly. Is this year going to be a bigger income year or a lower income year for you? Also look at your deductions. One of the biggest change in the tax law is to standard deductions and itemized deductions. Standard deduction has increased. Certain itemized deductions are limited, so it really could change people's tax pictures.
So let's say I know I'm looking at my tax returns from this, looking at 2018, and I say, oh, you know what? 2018, huge year for me. I made a bunch of money. 2019, I don't think I'm going to make as much money. What should I do with that information? If I am making more money for this year, what should I be thinking about before year end?
You could think about ways to defer some of that taxable income into the future. A great way to do that would be to try to max out your pre-tax retirement accounts. If you've got a 401k at work, try to hit that maximum contribution for 2018. Consider whether you could make IRA contributions if you don't have a 401k at work. And think about other ways you can kind of defer that income a bit.
Michael, what do you think about this idea of I'm making a lot more money this year? You did something for me years ago that was fabulous, which is you pointed out to me that, hey, you're self-employed. Why don't you put in your own retirement plan? What are some of the rules about self-employment and establishing a retirement plan?
Good point. If you have a self-employed income, you can set up your own retirement plan. There's many different types of retirement plans. Some of them have December 31st deadline, so it's really important that you know about that and set it up. The only plan that doesn't have a December 31st deadline is the SEP IRA, which you can set up all the way up until you file your tax return in the following year. However, this defined benefit plan, which will give you the maximum advantage and the most amount of money that you could potentially put away, is something that needs to be set up by year end.
What about this idea? We had this guy on the show who is named Ed Slott. You've heard he's like a fixture on Long Island. He says that we have got to get out of this idea that everything should be pre-tax, because his belief is that this is probably going to be the lowest tax structure that we are likely to see, he thinks, in a generation. I don't know what your view is on that, but how would that change your calculus about what you might have done in past years versus this year?
Well, this is a long game type of decision, and I absolutely agree with Ed, who's a wonderfully intelligent and great speaker. The issue here is a couple of different important points. First is clients tend to over-defer and wind up with all their money in these retirement plans. And they retire, they have a couple of bucks outside, but as they move into retirement, all the money that they want to live on is coming out of those retirement accounts, and that's taxable now. So some people can actually wind up in higher tax brackets in retirement than they had when they were working even. And they don't realize it. If you want to buy a car and that car, say, costs $40,000, you got to pull maybe $60,000 out of your IRA so that you can buy that car. So it's really important that people think about that and understand that while they might have a lot of money saved up on an after-tax basis, it's not nearly as much as they think.
But it is true. Like, people will call up the radio show, call up the podcast, and they'll say, I got $1 million. And you say, well, where is that? It's in an IRA. It's not $1 million. It's kind of like $650, depending on where you are, right? Essentially.
Right.
Okay, let's talk about this idea around the standard deduction being higher. Brenna, you mentioned this. I think 85% of filers will be eligible for the standard deduction. What does that mean in terms of year-end planning?
Well, it means things like, unfortunately, charitable contributions might not be as impactful in a given year, but there are ways to kind of make those more impactful in your future tax years or in occasional tax years. But state income tax, property taxes, those are capped at $10,000. So those deductions, especially for high earners, are not going to be nearly as powerful as they once were.
But for a high earner, one thing that is helpful is that your bracket went down. The rate went down on that top bracket, right?
Yes, your rate went down on the top bracket, and if you were really sucked into the AMT, that alternative minimum tax, in most situations, you're not going to be subject to AMT. So it's interesting. There's probably, because of the changes in AMT rules, your ability to itemize versus standard deduction, the rate bracket change, there's actually so many different permutations of scenarios that we've seen with clients. We tend to make this knee-jerk reaction and want to say, well, your situation, you're going to be better off or not. But in many situations, you can't tell till you actually run the projection, which is why we're strongly recommending that all clients this year more than ever go to their accountants, get projections based on last year and what they think this year is going to look like. One other really important point I want to make is the federal government made this assumption because the brackets went down that everybody's going to pay less tax. And while many people will pay less tax, surely not all, especially in high tax states. It's really important that you understand that they reset the withholding tables for people on their payroll. And a lot of people are withholding less now, not because they made a decision, but because the government made a decision for them. And therefore, they might be very surprised in April when they find out how much they owe.
We'll get back to your year-end money moves in just a second. If you've got a financial question, we'd love to hear from you. All you have to do is send us an email. Ask Jill at JillOnMoney.com. Ask Jill at JillOnMoney.com. And during the break, hop onto the website, JillOnMoney.com. You can sign up for our free weekly newsletter. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back with Jill on Money, and I know you're thinking about the holidays. You're thinking about all the stuff you have to do, and I'm just going to add to your list. I'm sorry. Because this is the time of year where you actually may be able to save yourself some moolah. So many changes have taken place. We had a new tax law go into effect earlier this year, and that really has changed the landscape for so many people. So part of the issue around your year end is trying to understand, did you withhold enough from your income to pay for the tax that's due? Yeah, you heard the politicians say, oh, everyone's going to save money. Not everybody. So in the second part of our interview with Michael Goodman and Brenna McLoughlin, who are both CFPs at Wealthstream Advisors, we're going to talk a little bit about that change in the tax code and what you need to know as you contemplate this year as well as next year. All right? So without further ado, more of our interview with Michael and Brenna. If you were withholding based on last year's tax outcome, how would that impact you in a year like this year if, again, you under-withheld? You just have to write a check. You're not going to be penalized, though, right?
Probably not penalized.
If you're paying quarterlies.
If you're paying your estimated payments, there's two different ways to pay estimated payments without getting into a lot of details. Most people pay on what's called Protect based on last year's income, and they'll be fine. But like I said, especially for self-employed people, you must go to your tax preparer, your accountant, your CPA, and get a estimate done for this year. It's really important.
Brenna, you mentioned this previously about charitable contributions. Do you think that charitable contributions will be reduced because the tax benefit has changed?
In our experience, the people that we work with who are charitably inclined and believe in giving have not changed their plan for this year, which is encouraging. I think charities should be encouraged by that. One way that we encourage our clients to give is instead of using cash, using appreciated securities. So if they own an investment, whether it's a stock, a mutual fund, an ETF, and they've had a gain in that position, they can donate that investment directly to a charity. Alternatively, they could use something called a donor-advised fund, which might allow them to make a big contribution in one year and several smaller gifts after that.
And this is kind of a neat concept. I love this because, some years you're feeling a little more charitable than others because you've made more money. You put more money into that fund in the year that you've made a lot of money, and you can just kind of swipe it in there. And that moment when you put a highly appreciated security into the charitable account, right, into that donor-advised fund, rather, then that's the moment that the gift is made, right?
That's correct. That's when you get the deduction.
Okay, so let's just pretend that you work in you're working for the man, you got a job, but you got a side hustle, and you made a bunch of money, and you feel good, and your tax liability is going to be pretty big. And you're going to itemize anyway. So you think for this year, I know I'm going to itemize. I could put a slew of money in right this second, take it from my highly appreciated security, next year I don't have to worry about it. I just have it funded for next year, right?
That's right. And there's a multitude of benefits from doing so. The first is that you get the deduction in the year you really need it because of that increased income potentially, right? A small side benefit is, we're all charitably inclined potentially, but we also want to make sure that we give it in a sort of measured fashion. If we suddenly give a much bigger donation than normal, we might find some new best friends that we didn't anticipate. But more importantly, in the past, the concept of bunching expenses was always something that we talked about in tax planning. But now with this higher standard deduction, it's even more important than ever. Because let's say you were donating $5,000 every year to charity, just making that number up, and that's not going to get you to the standard deduction. But going forward, you might want to do 15 every 3 years or something like that. So that'll help you with other deductions get over the 24 for married itemized deduction level, standard deduction level, so that it makes more sense. So bunching is even more important than ever.
Oh, my God. There's so much to think about. Let's talk about charitable for the required minimum distribution, which I'm now just doing for my mom. This has been in place already, okay? So we know that there is a way for people to use the tax code to basically say, I have a required minimum distribution. Instead of sending it to me, investment house, wherever you are, why don't you send it straight directly to my charity? And this is called a qualified charitable distribution, a QCD for people like you, Brenna. What does this do for some older Americans with the RMD structure?
So we love QCDs because you don't have to worry about whether or not your charitable contributions will impact or get you over the threshold for that itemized deduction. By doing a QCD, you're automatically removing that amount of taxable income from your tax return. It's not even going to be factored in. So you're automatically getting that deduction off the bat. The charity is benefiting from your contribution, and you're also lowering your adjusted gross income, which is impactful for other things like calculating your Medicare premiums each year. So for retirees, especially who may not be in a very high tax bracket or may not have many itemized deductions, they can ensure that they get the deduction on the QCD and then also help keep their Medicare premiums lower.
Interesting. All right. What other things should we be thinking about year end? We've now sort of scorched the earth on looking at our income. We're looking ahead. Does this mean, just in terms of bunching, that if this is a big tax year, are you still saying for a small business owner we should spend a lot of money on expenses for this year? Or does that kind of bunching still apply for small business owners?
Definitely. There's always been this inclination to try to bring expenses into the current year, the mindset being, I don't know what's going to happen next year, and I'd much rather pay less taxes this year because once that's out of my pocket, there's no way to get it back. But you do need to have some foresight and some planning. If you do have a sense of what next year might look like, you might be thinking about how that might work out.
Okay. Gift tax exclusion this year is how much?
$15,000 this year.
All right. So if you're married, you can give $30,000 to whoever you want.
That's right.
All right.
Keeping
that's
in
good.
mind, now the new estate tax lifetime exemption is pretty high, so very few people are actually paying the estate tax now.
I wish I had to pay the estate tax. I wish that I was in that situation. What about, Brenna, 529 plans? There was a slightly different twist on it with the change in the tax code, and that is that we always have talked on the show about, hey, put money into your 529 plan, so now you can put $15,000 or $30,000 as a couple. But now 529 plans I guess, is it finally determined that you can use it no matter what for private elementary or high school, or there's still state-by-state differentials?
So it's still not clear on the state level, unfortunately. So it sounds like a great benefit on the federal level, and it definitely was a big part of the tax code, but every state that we've looked into thus far is still resisting the ability to use 529 assets to pay for primary and secondary education.
Yes.
Now, no doubt.
I saw you wave your hand.
Yeah, I got to throw this one in. Yeah. I think this is really important. And the reason I say this is because, no doubt, it's case by case and individual by individual. But the money you're paying now for your kids, if they're in elementary school or so, it's just current cash flow and current expenses, which is hard. But I'm always a fan of sort of getting a grip of your expenses today and thinking a little bit more long term and long game here. And long game is college planning. And the reality of the college tuition is still going up higher and higher. And one of the dumbest things, Jill, one of the dumbest things people can do is spend enormous amounts of their personal fortune on college and ruin their personal financial situation, as you know oh so well.
That's why it's good to have rich grandparents like I did who paid for college. Thank God.
That's always a good option, too.
So much better. You should have tried that. You'll try that next time, won't you?
No doubt.
I know.
No doubt. I wish I could have done it the first time. But the point here is that the 529 plan, the power of the 529 plan, in my opinion, is not for the certain states that you live in where you get a state tax deduction. That's just sort of the carrot that gets people into the plans, but is the long term. So if you're putting money in while your kids are in grade school, you're getting tax-free growth of 10, 15 years of tax-free growth. And that's really the power of the 529 plans, not to use them short-term for elementary school.
We'll get back to Michael Goodman and Brenna McLoughlin in just a minute. Hey, did you know? Here's something fun. I've got a new book coming out. It doesn't hit the shelves, literally or figuratively, until February, but you can pre-order it. Just go to JillOnMoney.com. Click on the link at the top that says the book. It's The Dumb Things Smart People Do With Their Money. You can pre-order it right now, and then we will be right back to more of our interview about your year-end money moves.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You are back with Jill on Money. You getting psyched up for the holidays? I just found this funny survey. You'll like this one, Mark. You get together with your friends, your family, holidays, lots of gatherings, and a survey asked a bunch of adults what topics they considered too taboo to discuss. Yeah, you're right, Mark. At the very top, salary, retirement savings, size, and amount of debt. Even if you think of even religious beliefs, marital problems, drug use were less controversial than money. That's insanity. All right, before we go off on a tangent here about how crazy we are, let's do more concrete stuff. We're going back to our interview with Brenna McLoughlin and Michael Goodman. They are CFPs from Wealthstream Advisors. We're trying to help you navigate your year-end money moves. And in this segment, we're going to do a few odds and ends, things you should be thinking about. They're kind of evergreen, so pay attention. Here's the last bit of our interview with Brenna and Michael. What else do we need to be thinking about? Brenna, we did a lot of stuff already. What else should we be thinking about towards year end?
Well, I think you make a good point that we may be, and again, no one has the crystal ball, but we may be in a historically low tax rate situation right now. And there could be ways to take advantage of that by making after-tax moves of some kind in your retirement accounts. And that could be making Roth 401k or Roth IRA contributions. Or it could be, say this is an abnormally low income year for you, whether you're retired or you've changed jobs and you had a period of time without income, you might consider doing a partial Roth conversion of an existing IRA, again, to kind of put away some money after tax that can continue to grow after tax.
Do you want to try, Michael, to explain the backdoor Roth and the issue around the backdoor Roth?
Happily.
Okay. Oh, I love that. Look, you're like, bring it on, sister.
Let's do backdoor
Let's
Roths.
go.
I'm excited.
I know you are.
So the challenge in making contributions to Roth for a lot of people is they make too much money. So they can't make straight up contributions. So they lean towards conversions because people can do conversions regardless of your income level. But if you don't have an IRA to convert, you can't do a conversion. So what we do is we take the non-deductible contribution where people take a straight up IRA contribution that's not deductible because you make too much money, and you put it into an IRA account because anybody's allowed to make an IRA contribution. The real question is whether or not it's deductible. Once the money's inside of the IRA, you now have the ability to convert because you have money inside of an IRA to convert, and therefore it is known as the backdoor Roth contribution.
There is a weird caveat that if you have if you do have an existing IRA, what happens around that backdoor?
So if you have an existing IRA, and you convert, the IRS looks at all of your IRAs when you go to convert. So if you have, say, $100,000 in an IRA and you want to convert that, they're going to look to that $100,000 as well as the $5,000 you might have already put in this other account and prorate your ability to convert that. So a high portion of your conversion, about, let's say in my example, approximately 95%, is going to be taxable.
So, in other words, if you have existing IRAs, generally speaking, if you have a specific question, you can obviously ask us. But generally speaking, if you have existing IRAs, don't be worrying about the back door. Start converting the existing IRAs a little bit at a time, because then you're not subject to that weird rule, right?
That's right. As long as you're in a low enough tax bracket that it makes sense to convert. I agree. The other option is if you're self-employed and have a self-employed 401k plan, you can roll your IRA potentially into your 401k, and now you don't have the IRA to worry about.
Oh, right.
You can also roll your IRA into your company 401k and not have that issue to do backdoors. You just have to be careful that make sure your company 401k is good enough 401k for you to roll that IRA into. So you don't want to sort of put it into a bad plan where you have sort of crappy investment options if it doesn't make sense.
Very good. Let's talk about selling losers. Why are people so ridiculous about selling losers? What is their problem? They seem to that's not your child. It's a crappy investment. Sell your loser. Why are people struggle? Why do they struggle with that?
I think it's the resistance to admit defeat.
Ooh.
I think that that sometimes it's just too painful to see that number, that loss number, and accept the fact that that investment is not going to kind of turn around for you. Some people just think if they wait long enough, a loser will eventually become a winner again, and that may be true, but it becomes more difficult to pin down if you're talking about a single company's stock.
By the way, I also feel that way about relationships, that loser may come around, but chances are you might as well cut your losses. What about people who have company stock? A lot of times I'll say to people here at CBS, unload it, and they freak out. They cannot do it. It seems to me that the company stock is a separate weird animal. What do you say to that, Michael?
It is a weird animal, and people have an emotional commitment to their companies in a lot of ways. They feel like they're being disloyal, in fact, by selling the stock. And it couldn't be any further from the truth. The reality is you're contributing your entire human capital to that company. So much of your personal net worth is tied up in that company. Textbook response is to not have all your income and your equity tied up in the same company.
Brenna, if you have a client who comes in, it's got $1 million, generally doing fine, what percentage in an individual company stock makes you feel okay?
Ooh, good question.
Thanks. Burning questions.
So I wouldn't want it to be any more than 5% under any circumstances. I think 5 is even maybe a little high for an individual company in a portfolio. But, when we see a new portfolio come in, we're sort of giving second opinions on what somebody currently owns. Our first piece of advice would be to kind of try to manage any concentrations in a single company to trim them down to 5%. And that's usually a first step in further diversifying.
What if your client says, Michael, but the stock's in the gutter. I don't want to sell it. I know. What's your response to that?
Would you buy it now? Do you think it's a good investment? And sometimes that works, sometimes it doesn't. The second question I would say to them is, do you think that stock's going to outperform the market as a whole? And a lot of times they don't know, and it's a reasonable response. They just don't know. Well, my response to that would be, it better, right? Because if it doesn't outperform the market as a whole, you're taking on way more risk to own that stock. So you should be better compensated than the market as a whole.
Well, thank you so much, Michael Goodman, the Hefe of Wealthstream Advisors, and Brenna McLoughlin, a CFP. They are just filled with information, lots of great resources. We also have a huge post up at Jill on Money about year-end money moves that incorporates a lot of this information. So check it out at JillOnMoney.com. And if you've got a financial question, give us a holler. Ask Jill at JillOnMoney.com. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. All you have to do is send an email. Ask Jill at JillOnMoney.com. And well, sometimes we have you on the air and I ask a follow-up question. That is what happened with Lisa, who had some money in an old 401k account. And she was talking about whether she should roll it over or rebalance it. She said she and her husband have other rollover accounts at Fidelity. And so she wanted to know, like, what do I do? And I said, why don't you just send me the actual breakdown of what you have? And she sent me this long list of stuff. And, some of it is interesting. I mean, there are a lot of choices in here. Some of them are, decent options. Nothing that like blows me away. So what I'm going to say is there are some good funds in here, Lisa. There are some T. Rowe Price funds. There are some Vanguard funds, and they're cheap. However, there's not necessarily anything here that makes me think like, wow, you should stay in this place. In fact, I mean, you can choose low-cost index funds at Fidelity, and you would consolidate what you have. I think that might be the better idea. So, Lisa, I mean, if you didn't have a new plan, or your new plan was stinky, or you had no accounts at Fidelity, then there were plenty of choices in here. But I think that I would roll it over, consolidate it, and kind of don't look back too much. I think that's just fine. All right. So thanks for the follow-up. Tina writes that let's see, she's 56 years old. Her husband is 66. He retired at age 62. Now she wants to retire. She can be with him. Hey, you know what? Be careful what you wish for. That's all I can say. But she writes he has a bad heart. I don't know how many more years his health will last. Okay. They both have pensions. He's got, why don't I have a pension, Mark? We got to start a pension plan for ourselves. $4,200 is his pension. Hers is $2,100. He collects Social Security of $2,000 a month. And their house and cars are paid for. 401k and Roth total $950,000. So let's just look at what we got here. So we got $8,300 a month pre-tax. Now, what she says is, I think we can afford for me to retire, but he's nervous about my losing $84,000 in annual income. We live in Connecticut. We're not going to move because our grandkids are here. What do you think? Do we have we saved enough to retire? You left out one major piece of information. What's that, Mark? What do you spend? Mark says. If you spend $5,000 a month, then you're golden. If you spend $10,000 a month, then you're not so golden. You probably don't spend $10,000 a month. But here's the thing. I mean, obviously, not having that $84,000 a year is important. There's a few more things to keep in mind. Number one, if he predeceases you, what happens to his pension? Will you get a portion of that? That's important. What will your Social Security benefit be? I mean, part of the reason not to retire for you is that, I'm just going to round it up. You got $1 million. That's all well and good. But you're really young. And, from that $1 million, you can maybe pull about $30,000 a year and keep it safe and sound. So this is really an important distinction. You really need to be thinking about two things. One is, can we afford this today? But the other part of it is, what happens to me in the future? I mean, not retiring basically allows you to keep paying for your expenses and not invade your other assets. Would your pension continue to increase? That's a question. Could you maybe scale into this? Like perhaps going to your employer and seeing if you can work part-time? I don't know. I'm reluctant without knowing the big piece of information. The magic question is, of course, what do you need to live on? and what happens to his pension upon his death. And if you think that, if you're really wondering about, can you do this, you may want to talk to a certified financial planner or maybe a CPA who's got the designation PFS. You want to talk to somebody who can help you look at this situation as is, but also in the future, because we don't know. And I understand wanting to be with him. Of course, that makes all the sense in the world. But I also understand that my job in hearing this conversation, and anyone who's doing any planning, would be, how do we ensure that both of you are taken care of, right? That's really important. So give us a shout back. Maybe we can do a little. I would love to get this person on the air, Mark. I know you tried, but I think it'd be quite interesting. You see, there's a lot of moving parts to this. Okay, you're listening to Jill on Money, and if you've got a financial question, give us a shout. It's Ask Jill at JillOnMoney.com. We'll be right back. You're back with Jill on Money. If you've got a financial question, we would love to hear from you. Our email address is askjill at jillonmoney.com. Before we close out the program, let's take one more question. It's from Bob, and the subject is mortgage. Bob writes, my mortgage rate is 4%. The balance is about $73,000. How do I figure out if I should pay it off or use this money to invest? My tax bracket is 24%. The mortgage is fixed, 30-year fixed. My mortgage principal and interest is about $400 a month. Well, it's actually a larger question, isn't it? Because it's not just a question of use of money. Because let's say, your 4% mortgage is really costing you something like 3.5%. Let's say it's 3.5%. I don't know what state you live in. But I think the more interesting question is, are you saying that this is $73,000 that you have sitting in cash, which is 73 of $1 million you have sitting in cash? It really depends on your liquidity. It depends on your ability to be able to kind of do all the things you want to do. Without much more information, what I can tell you is it's usually my preference to maintain the mortgage, at least while you're still getting that mortgage interest rate deduction, and to give yourself some options in the future, because once you pay off that mortgage, that $73,000, it's done. It's gone. And at 4%, that's pretty cheap money. Look, if you had a bunch of money that's sitting around and it's earning 1% or 2%, and you said, oh, I have $500,000 in a bunch of CDs and I want to use some of the money to pay off the mortgage, sure, then yes, Bob, that makes sense. But if this is really going to burn up a ton of your liquidity, then I think not. I think not. You can see that one of my themes is always about liquidity. So let's make sure you remain liquid. Okay, that's it. That's the show. And just know that all week long, we're checking our email box. So send us your questions. Ask Jill at JillOnMoney.com. We'd love to hear from you. If you've got anything at all on your mind, you can always go to the website, Jill on Money. We have a Contact Us button. And there you can sign up for our free weekly newsletter and pre-order the book, The Dumb Things Smart People Should Do with Their Money. All right. We'll be seeing you next week. Thanks.